Welcome to Alpha Insights. I'm Evan, your guide through the ever-changing financial landscape. Today we have an exciting topic that I know will resonate with many of you: saving versus investing. What should you do with your hard-earned cash? To break it down for us, I'm thrilled to introduce our guest, Ashton, a portfolio strategist who makes complex concepts clear and practical. Ashton, great to have you on the show.
Thanks for having me, Evan. I'm looking forward to diving into this crucial conversation. It seems like everyone has questions about when to save and when to invest.
Absolutely. So let's start with the basics. Can you explain the core differences between saving and investing?
Definitely. At its essence, saving is all about safety and liquidity. You keep money in a savings account where it's easily accessible, but the trade off is lower returns. On the other hand, investing is aimed at growth. You're putting money into assets like stocks and bonds with the expectation that they will increase in value over time. That comes with some risk, as investments can experience fluctuations.
So essentially, saving is for short-term needs while investing is focused on the long haul?
Exactly. If you need cash in the next few years, you want to prioritize saving. But if you're looking at a goal that's 5 years out or more, then investing makes more sense. This is where we also need to discuss the importance of having an emergency fund.
Right. I hear a lot about emergency funds. What's the guideline here?
Most advisors recommend setting aside 3 to 6 months worth of essential expenses. If you have a stable job, start with 3 months. If your income is variable or if your job security feels shaky, go for 6 months or even longer. This cushion prevents you from having to sell investments at a bad time.
That makes a lot of sense. Now, let's say someone has their emergency fund set. When should they start investing?
Great question. Once you have that emergency fund in place, and especially if your goal is more than 3 to 5 years away, you can start looking into investments like stock index funds. These funds offer growth potential and are typically lower in cost.
For someone just starting out, what's the best way to approach investing?
You can start by looking at broad market stock index funds, like those tracking the entire US stock market. They give you diversification across many companies, which helps spread out risk. And don't forget about bond funds for a bit of stability.
So it sounds like balancing between stocks and bonds is key. But how do people figure out their risk tolerance?
A simple framework can help. Ask yourself 3 questions. First, what's your timeline? If it's under 3 years, favor savings. Second, how likely are you to need the money unexpectedly? And third, can you handle market losses? If the answer is no, lean more towards savings or conservative investments.
That's a fantastic perspective. Can you share any common mistakes people make with their money in this context?
Sure, one of the biggest pitfalls is skipping the emergency fund. Without it, you might end up selling investments when the market dips. Also, leaving long-term investment money in low-yield savings is a mistake because of inflation eroding your purchasing power. And don't forget, any short-term needs should stay in conservative savings, not volatile investments.
It sounds like being disciplined and systematic is crucial. Any final takeaways for our listeners?
Absolutely. First, always build your emergency fund before diving into investing. Second, match your savings or investments to your time horizon. And lastly, automate your contributions, whether it's to your savings or investment account. It simplifies the process and encourages consistency.
Great advice, Ashton. Thanks for breaking this down for us. Investing and saving can feel overwhelming, but understanding when to do each can really empower our listeners.
It was my pleasure, Evan. Just remember, the key to financial health is patience and planning.